Good morning and welcome to the Killik & Co Market Update. This week saw the Federal Reserve give its penultimate interest rate decision of 2019 and effectively cut interest rates by 25 basis points, or 0.25%. So that's the third time in a row in which it's done so, and since July interest rates out there have fallen from 2.5% to 1.75% as to where they are now. So going into the decision, it was widely expected. Markets were in fact pricing this in with around a 90% probability, but there have been some subtle changes in the statement that the Fed releases alongside the interest rate decision. So effectively, between the statement and Jerome Powell's press conference afterwards, the message is effectively that the US remains on hold pending further interest rate cuts, and it's going to be assessing the incoming information from the market in relation to US-China, obviously trade deal, trade wars, and also the underlying market data. And if there is deterioration, it may well obviously seek to act further. So clearly US-China trade war is still very important to the Federal Reserve, but they're also calibrating for the underlying health of the economy, which is a little bit of a change in terms of what we've seen most recently. So just looking at the market expectations for the forthcoming set of FOMC meetings, and those FOMC meetings is where interest rates decisions are taken and made. This chart shows us the market implied probability of when the next rate cut might occur. So we can see that there's currently a 30.4% probability that the next quarter of a point cut comes in November, and that there's an 82% probability that the next rate cut would have taken place by the end of next year. So whilst there's been a lot of talk around the potential for US rates to move into negative territory like they are already in Japan, Switzerland and Germany, for example, we'd need a further 7 quarter-of-point rate cuts to get there. And as you can see from this slide, the market's nowhere near pricing in that as things currently stand. So clearly, if we do start to see further deterioration on a global basis or in the US, some of those 7 rate cuts may come sooner than expected. So the US-China trade war has arguably become as common a feature amongst the headlines as Brexit has. And listening, or whilst it can be tedious, I guess, reading the same headlines and listening to the same rehashed one-liners, the effect is still very clear, or its importance rather, is still very clear within financial markets. So the Federal Reserve, as we know, have used the trade war to help set interest rate policy, and global money managers will have been acutely aware, rather, of its effects and its presence when trying to allocate capital where, how and when, I guess, of client money. So from the US standpoint, we know that industries such as the steel industry and the agriculture industry has been negatively impacted by the trade war. And in fact, we've seen a number of headlines around Chinese increases in agricultural purchases as part of a phase 1 or the wider trade deal. So obviously this is important for farmers, but it's very important for President Trump as well as he heads into next year's election to keep the US farmer base on side, where he has a fair amount of support. So we also hear a lot about US consumers, but we don't hear so much about the mindset, or the mid-trade war mindset of Chinese consumers. So I just want to spend a couple of moments just talking about, or picking up on some of the things I've been reading about over the last couple of weeks. So we know that a number of Western brands have made expansion into China the backbone of their growth strategies, and that for some time Western brand ownership in China has been seen as somewhat as a status symbol amongst the Chinese middle class. But something that I didn't know, for example, was that GM, or General Motors, now sells more cars in China than it does in the US. But the trade war has made mainland consumers eager to help support domestic companies and domestic brands of all kinds. So reports suggest that the trade war has stoked a surge in anti-Americanism or Chinese nationalism, and those kind of feelings are starting to spill through into marketing decisions, and also into starting to influence consumer brand awareness, buying habits. So you may recall that the NBA, or the National Basketball Association in the US, caused an uproar when one of its executives tweeted publicly that it supports pro-democracy protests, or supporting pro-democracy protests in Hong Kong, and that move widely saw Chinese retailers pull NBA merchandising off the shelves. So those kind of instances potentially helping to fuel some of that buying local trend. So domestic brand strength does seem to be growing. So smartphone maker Huawei has flown up the most loved Chinese brands. to the number 2 spot now. I think actually Alipay is number 1. But after the US government played an important part, obviously, in arresting the Huawei CFO in Canada last year. So Huawei is now actually the largest seller of smartphones in China. If we rewind to 2012, it was only the 5th biggest seller of smartphones into China. So there have been a number of online articles promoting support for domestic brands, and they seem to be gaining a little bit of traction. So when you consider, and also when you consider the advances in end product quality from Chinese goods, it's becoming easier for mainland consumers to buy Chinese products. So should Western brands be concerned about Chinese protectionism or Chinese consumer boycott of US goods? I don't think anybody's panicking just yet, but it's clearly something that the likes of GM, Nike, and Apple, for example, will be watching very closely. So just touching very briefly on Brexit and general elections, as expected, the EU has granted the UK a flexible 3-month extension to get Brexit over the line, and there is a general election on the 12th of December. So with the vote split across more parties than usual, forecasts are suggesting that there's even more uncertainty around the polling forecasts than is usual, which is saying something. So unsurprisingly, it looks set to be a Brexit-based election, and as it stands, the Conservatives had the upper hand in the most recent polls. Here we can see that the Tories have around a 14-point lead based on the average of 5 recent polls, which could translate into something like a 40 to 50 seat majority. In somewhat related news, Jack Dorsey, the CEO of Twitter, announced that the social media platform would ban all political advertising as it can be used to influence voters, which affects the lives of millions. So the new rules come into effect on the 22nd of November, so the timing will have some effect on the UK elections. And it probably goes without saying that somebody in the White House had something to say about it, as the rule change will also affect next year's presidential elections. Just looking ahead to companies reporting next week, fairly full calendar again, but we'll be looking out for the likes of Vonovia, Walt Disney and Engie. That's it from us this week. Have a great weekend and we'll see you next week.